Well, hello everyone and welcome to our first business and market update for 2017. And it promises to be a fascinating year for investors. Amid the distractions of the US election, most major global economies finished 2016 on a reasonable note with modest economic growth, modest inflation and slightly rising interest rates. The world is now focusing on what President Trump will do post-inauguration in enacting his new policies in the first 100 days. Regardless of this, some key themes, common themes remain for investors throughout 2017. Monetary policy will remain important, regulatory change, US external policy, Chinese economic policy, geopolitical tensions will remain important, and obviously the growth outlook, where we are at in the economic cycle, and interest rates will all be important to consider. Our CIO Lucas DePauw will address these issues each month in our Investment Outlook report, and he'll give you his view and his take on how you should position your portfolios. The Investment Outlook report is updated quarterly for our quarterly outlook and dynamic asset allocation tilts, and it encapsulates all of the intellectual property of the Lonsec research team. In order to properly harness these insights, we suggest you take one of the following approaches. Either you can engage Lucas to construct a tailored portfolio for you in a managed account structure, including his full participation in your investment committees. You could also, if you don't want to pursue a managed account structure, engage our investment consulting team to assist you with investment committee participation, model portfolio construction, and approved product list construction. Or you could simply read the Investment Outlook report each month and get our dynamic asset allocation tilts, which are updated every quarter. So with that in mind, I hope you have a good start to 2017. Now I'm going to hand over to Bill Keenan, who's going to give you his stock market update for January.
Welcome to the first market update of the year. We're joined by Bill Keenan, General Manager of Direct Equities Research, to bring us the latest market developments. And Bill, Donald Trump's Twitter account continues to impact markets, including European auto shares and the US currency. Can we expect this sort of politics-driven volatility to continue throughout 2017?
Yes, well, I think the new president is using his Twitter account because he doesn't trust the US media to report what he's saying correctly. So that's the first unusual thing about the new president. But I think markets are just hungry for information at the moment. There's a lot of uncertainty with this new administration and they're reacting to what he's saying in his Twitter account. I think over time that people will see that there's a fair gap between rhetoric and reality in terms of getting these policies through Congress and facing the international consequences of some of these policies. So I would expect that that a lot of the policies will be watered down by the time they get through Congress, and that the markets will start to focus a bit more on the policies rather than what Trump's saying via his Twitter account.
And the US Fed is still positioned to continue increasing rates, but what sort of pace can we expect throughout this year, and what's the outlook for inflation?
Yeah, well, inflation has in the US, core and headline inflation is now above 2%. That's the highest it's been for about 2 years. And so inflation is starting to pick up before the Trump administration actually comes in with these expansionary policies. So I think it's caught the Fed a little bit off guard in that they're probably behind the curve now when it comes to inflation and interest rates. And they're talking about around 3 rate rises a year from here. So you could expect 3 rate rises this year. That would take the cash rate from 0.75 to 1.5% by the end of the year.
And looking at the Australian market, it did have a bit of a rocky ride through 2016, but did end up delivering a pretty solid performance and beat the world index as well. What were the main sectors driving that performance?
Yeah, the market rallied in the latter part of the year. It was a little bit misleading. If you look behind actually what's driving that, was really only 2 sectors, being financials and resources, which together do make up about 55% of the index. But they had a strong run into the end of the year. I think financials are up a bit over 18%, materials 23%. Now, not many fund managers have a 55% weighting to these sectors. It's very heavy. So you would have seen that a lot of fund managers would have underperformed into the end of the year. So it really has been just a couple of sectors driving the market. Now, as we go into profit season, I think we're going to see that not much has really changed for the growth outlook, and that is mid to high single digit sort of growth. The only sector really that will have a turnaround in growth is resources because of the turnaround in commodity prices. So there will be some major growth there, but the other sectors we're not expecting too much. So it'll be interesting to see as we go through profit season. Already we've had an upgrade from CSL and then a downgrade from Brambles. So we'd expect similar sort of choppiness as we go through profit season.
And looking at economic data as well, it's been quite a quiet month for Australia and no RBA meeting in January. But is there a sense that the underlying strength of the economy is improving, especially since that negative GDP print? And how are we shaping up economically?
Yeah, the negative GDP print in September was a bit of a rogue figure. It was a negative 0.5%, and all the categories happened to turn negative for that quarter, which was just a base effect and a bit of an unusual event. In the December quarter, I'd expect a couple of components to turn around, being private consumption and exports. Remember, commodity prices have been a bit stronger. So two sectors should turn around that should see growth return in the December quarter. And certainly no one is too bothered by the negative print at this stage. And if you just look at it anecdotally, commodity prices have recovered. So you should see a pickup in WA and Queensland to do with iron ore and coal. We've seen that the currency is still pretty low, which is good for exporters and also for the tourism industry. And then we see the housing market is still reasonably buoyant in Melbourne and Sydney. And then we see unemployment at the moment is around 5.8%, nothing too bad. So based on all the data, there doesn't seem to be any evidence of any sort of recession coming through in the figures.
And finally, looking at Europe, there's been some interesting developments coming out from there as well, with Theresa May giving her Brexit speech last week and French elections coming up as well.
Yeah, I think we're turning our heads at the moment between the US and Europe, trying to see what's going on. There's certainly plenty of action, and at the moment with the new Prime Minister Theresa May coming out, pretty hard line on Brexit, saying that they want to play a clear exit from the EU. And that no deal for Britain is better than a bad deal for Britain. So they're almost painting a romantic vision of the global Britain empire, and that they're a free trading Britain once again, and that they're just ensuring the EU thinks about the importance of Britain to the EU, and that is in terms of security, its financial hub in London and the export markets of Britain. So I think they're just painting a hard line at this stage. The French election is interesting. That's coming up in April. That's one of the largest sectors of Europe, along with Germany. And there is thinking that the French could move to the right, like we're seeing globally. Certainly they've been affected by terrorism probably the most in the last few years. And that a move to the right there could put more pressure on the EU structure there, where certain countries seem to be going back to their own politics and their own geography rather than the EU. And some believe, though, that this shake-up of politics in Europe and Britain is good because growth and inflation is pretty stagnant, and that something was needed to be done to reinvigorate these economies. So some actually take a contrary view on what's happening in Europe.
Well, it looks like another tumultuous year for 2017, and probably a few left field events as well. Bill, thanks very much. And to our viewers, thanks very much for tuning in. Remember, for better investment outcomes, visit lonsec.com.au.